Hello, and welcome to a discussion of Chapter 3, Effective Debt Management. A man in his 50s came to me with some serious problems. He had just started a small business and was buried in debt. He had taken out both personal loans and business loans and also maxed out both his personal credit cards and his business credit cards. At the time, he owed approximately $450,000. He lacked adequate cash flows to service the debt and was worried about having to close the business down. 5 years after we developed and implemented successful personal and business plans, including personal and business debt management plans, he achieved a debt-free personal and business life with plentiful cash flows and significant net worth growth each year. To this day, he lives a full and joyful life and in fact has funded a family trust in excess of several $1,000,000 to assist various members of his family. Depending upon how debt is managed, debt can be a tool for growth or a source of financial ruin. Therefore, in every life plan, it is critical that everyone understands the different types of debt and exactly how to manage debt wisely. Here's a case study. A middle-aged general contractor called me one day and stated that he would like to discuss a few business matters. As frequently happens, a few was significantly more involved than initially indicated. He had been in the contracting business for approximately 10 years and experienced the many ups and downs typical with any small business. He was regularly able to generate approximately $1,000,000 in annual revenue, but the initial assessment indicated that every aspect of his business required further refinement in order for him to be successful. The personal and business bank accounts of the client had very little in reserves and working capital. He had multiple personal and business loans and credit cards with high balances and very little remaining available credit. The combined personal and business debts were in excess of $1,000,000 with insufficient monthly cash flow to service the debt and execute on a debt paydown strategy. He was barely afloat and unable to grow his net worth or fund his retirement plans. He was worried about losing his business, his family home, and having to file for bankruptcy. Although the client and his wife were both extremely competent and hardworking, they had not followed the general rules of financial planning and were facing economic collapse and many years of personal and business hardship. First, the books and records needed to be assembled and organized for review. After reviewing the details of their books, records, and tax returns, we developed a full financial plan for them and began to make the adjustments required to meet their goals. The strength of their current assets and liabilities were analyzed and compiled into the balance sheet of a financial statement. Projections were developed and discussed regarding the management of their assets and liabilities for the remainder of their lives and in their estate. The financial statements, tax returns, and operation of each of their current businesses and other more complex investments were also fully analyzed and discussed. Their personal and business matters required a significant restructure process, both internally with operations and staffing, and with all outside business relationships with vendors and creditors. Upon completion of the restructure planning process, we began implementing both the financial and relationship adjustments required for them to implement their personal and business turnaround and begin to strive for their goals. When both their financial and relationship issues were addressed at the personal, business, and investment levels, they obtained peaceful, well-managed lives. Today, each of them lives with daily peace of mind and gratitude for their secure and loving financial, personal, business, and family lives. Understanding different types of debt. Debt can be classified into two main categories: performing debt and non-performing debt. Performing debt is considered an investment that will grow in value or generate long-term income. Mortgages and student loans are prime examples of good debt. A mortgage, for instance, allows you to buy a home which typically appreciates over time. This not only provides you with a place to live, but also builds equity, which can be a significant financial asset. Similarly, student loans enable you to invest in your education, which can lead to better job opportunities and higher income. On the other hand, non-performing debt refers to debt incurred to purchase items that do not increase in value or generate income. High-interest credit card debt falls into this category. Credit cards often come with high annual percentage rates. This makes them one of the most expensive forms of debt. These types of debt do not continue or contribute to your net worth growth and can quickly become unmanageable if not managed correctly. Debt can also be categorized as secured or unsecured. Secured debt is backed by collateral, meaning that the lender has a claim on an asset if you default on the loan. Mortgages and auto loans are common examples of secured debt. If you fail to make your mortgage payments, the lender can foreclose on your home. Similarly, if you default on an auto loan, the lender can repossess your car. Secured debts typically have lower interest rates because they pose less risk to the lender. In contrast, unsecured debt is not backed by any collateral. Credit cards and personal loans are common examples of unsecured debt. Because there is no collateral to lessen the lender's risk, these types of debt usually come with higher interest rates. If you default on unsecured debt, the lender can't seize your assets. However, they can take legal action to recover the money, which can result in debt collection actions, wage garnishments, and other high-cost penalties. Another important debt distinction to understand is between revolving and installment debt. Revolving debt, such as credit card debt, allows you to borrow up to a certain limit and repay it over time. As you repay the borrowed amount, you can borrow again up to the limit. The balance and payment amounts can vary from month to month, which makes it flexible, but also easy to create a dangerous, constant growing debt situation if only the minimum payment is paid each month. Installment debt, on the other hand, involves borrowing a fixed amount of money and repaying it in fixed installments over a set period of time. Student loans and personal loans are examples of installment debt. These loans have a set repayment schedule, which makes it easier to budget for them. Understanding the different types of debt and their impact is critical for effective debt management. By recognizing the characteristics of good and bad debt, as well as the differences between secured and unsecured debt, you can make informed decisions that will help you achieve financial stability. Managing debt wisely involves not only repaying what you owe, but also making strategic choices about which debts to pay and when and how to avoid accumulating unnecessary debt in the future. Strategy for debt repayment. Smallest first. Focus on paying off the smallest debts first while maintaining minimum payments on your larger debts. The strategy of paying small debts first provides a sense of accomplishment and relief and boosts motivation. Seeing your progress as various debt accounts are paid down to zero helps you to stay committed to your debt management plan. Please remember, though, that unexpected expenses will happen from time to time. A good strategy is to build up and keep some emergency funds, which may be applied to unforeseen circumstances. Emergency funds bring peace of mind, just having them available, as well as when they must actually be used to handle an unexpected expense. Strategy for debt repayment. High interest first. Another debt repayment strategy is to focus on paying high interest rate debts first and reducing the cost of borrowing as quickly as possible. Start by listing all your debts from the highest to the lowest interest rate. Make minimum payments to all of the debts except the one with the highest interest rate. Direct any extra money you have towards paying off that high interest debt. Once it's paid off, move to the next debt on the list, applying the extra funds to it. Reducing the principal balance on high interest debts first decreases the amount of interest that accrues, accelerating the debt repayment journey. Negotiating with creditors. Tips for reducing your debt. Effective debt management often involves negotiating with creditors to secure better terms. Proactive communication with your creditors can make a significant difference in your financial health. Building a relationship with your creditors is crucial. When you demonstrate a willingness to repay and maintain open lines of communication, creditors are more likely to be flexible and accommodating. This approach not only helps you manage your debt more effectively, but also shows creditors that you are serious about resolving your financial issues. By being proactive, you can often negotiate lower interest rates, extended payment terms, or even negotiate settlements for less than the full amount owed. Avoiding debt traps. Debt traps are financial pitfalls that can quickly escalate into significant problems if not managed carefully. Avoiding debt traps requires planning, discipline, and a commitment to your financial well-being. By building an emergency fund, using cash or debit cards, and setting up automatic savings transfers, you can steer clear of high-interest debt and maintain financial stability. Remember, the goal is to make informed choices that support your long-term financial health, allowing you to focus on achieving your broader life goals. Peace.